Hey there everyone, today we're going to be talking about how to invest in real estate for beginners and also the two best strategies that I have found when investing in real estate. And this is going to be split up into a 2-video series, so stay tuned for the next video after this. But there's one more thing, if you hit this description up top, there's another video before this if you haven't seen it that lets you know everything that you need to know and that we'll be talking about in this video about real estate. Now let's jump right in, and I'll let you know right now that there are two main ways that people invest into real estate. Now there are different techniques that people use to make money with real estate, but these are the two biggest moving parts in real estate when you're trying to make the most money possible. So the first way that people can make money through real estate is by accessing a market that is appreciating at high rates. Now this strategy usually only works if you're entering in a market that has high growth rates. So just one example of something like this would be a place like Miami, Florida, where the appreciation of a home is much higher than what it is in most markets. With this strategy, you need to follow another certain step of rules, which is the buy and hold strategy. So basically what I'm going to be doing is I'm going to be obtaining an asset, not making very much money each month, and maybe even breaking even each month, depending on how you're doing this. But over time, in those markets where the value of your home is appreciating, your home is going to be making tens of thousands of dollars as it sits there over time. And this is just because the market is highly desirable, people are coming into the market, and everyone is looking for a home. Then once this house is appreciated by tens of thousands of dollars, they're able to either sell the home and keep whatever equity they make in the home, or they're able to cash out, refinance, and put it into a new home that they can start using for appreciation as well. Now, I don't think this strategy should be used solely to make money in real estate, which is because one, it is almost completely dependent on how a market is doing. So if that market starts to drop and we have a black swan event like we just did, all of your appreciation in an asset could drop dramatically and you could end up not making that much money. So while I think this is an important aspect to have when you're investing in any type of real estate, it should not be your sole aspect that you're looking for, because if you rely only on this, you might end up with nothing, or you could end up with a lot less than what you thought you were going to. Now, the second main way that people invest in real estate is trying to get the largest gap from what your mortgage is to how much your tenant is paying, and setting up a very large amount of passive income through the purchasing of multiple properties. And this is the method that we're going to be talking about today specifically, and we're about to get right into it. So first off, I'd like to just let you know how I came across this method of investing. When my first mentor started teaching me about the ways to invest into real estate, this was the biggest one that came up for him in his life. And there are a few reasons for this. When he first started off in real estate, he was unable to get a loan from a bank or even have anyone lend him the money. This led him to purchasing his first home outright in cash. Now, he didn't even plan on using this as an investment property. He just purchased this first home as a residential home. But after so many months of living in it, they decided to turn it into an investment property and move into a different place. What he found out very quickly was that he was making a lot of money monthly because he owed absolutely nothing for a mortgage payment because he paid for it outright. And he was making about $1,000 every month from having a tenant in that home. So from there, he figured why not try and get as many homes as he possibly can, because the more homes that he obtains, the more passive income he'll be making monthly. So that's exactly what he did. With the home that he had that was bought outright, he decided to take a HELOC, which is a home equity line of credit, out of his previous home. Now, we talked about this in the last video, and once again, if you don't know what this means, go back to that last video because it's going to explain it for you. But after he took this amount of money of the home that he was previously in, he used that as a down payment for his second property. And with this second property, he was now making the passive income of owning 2 homes with 2 tenants in it. Now, the problem is that the market that he bought his 2 previous homes in was starting to rise dramatically. And eventually the average home price was around $250,000 to around $300,000. Now, while that was great news for the 2 homes that he had previously bought because they had appreciated so much, he was now unable to purchase homes and have a large gap between what a tenant was paying and what his mortgage was. That's why he started to look in different markets with lower prices of homes. And with this method, he would find homes where the mortgage payments would end up being around $200 a month. And it would rent for about $700 to $750 a month depending on the home. The mortgage prices change a little bit and the rent changes a little bit. But with these homes that he's doing, he's averaging about a 20% ROI with all of the homes he has in that market. Now, this is so great for a few reasons. One thing you have to keep in mind is when he purchases multiple homes, his income has a much less likely chance of being affected at any events that happen. So for instance, if he had 2 homes in this market and one tenant decided to stop paying or move out, or it went vacant for a long period of time, he would lose almost 50% of his income. Now that's a big deal, and that's a hard problem to get through because you only have one other home that's keeping you afloat. But if you were to purchase 5 homes and one of those homes went vacant, or a tenant didn't pay, or you had legal problems with it, or whatever it may be, you would only be losing 20% of your income. So what you want to understand especially is the more homes that you purchase, the less likely you are to take hits when vacancies come around. Now this especially plays into not wanting to pay these investment properties all the way down. And here's the reason why. Once you pay these investment properties all the way down, you lock up a certain amount of money in these properties that you could be using for other investment properties that would make you even more money. And like we just said, the more investment properties you have, the less likely you are to take any hits or have a fallout in your investments. So if the market ever fluctuates, or we have a black swan crisis like we do right now, and 1 or 2 of your tenants leave, it's a lot better if you have 10 homes than if you have 2 or 3 or 4 homes. The more homes you can get is the key in this method of investing. And also, you can purchase in markets where they're appreciating more, but in the ones that my mentor is invested in, the markets don't appreciate much at all. In fact, depending on where you're at in the state that he's investing in, it can range from as low as 1% appreciation to just a few percentages higher than that. And the really amazing thing about this is after you have so many homes for so long, you're able to do a bunch of different and creative ways of investing with those homes now. Such as you can take out a cash out refinance with another bank and you can invest it into another group of properties. Or you can even use the HELOC to go and put down payments on different homes. But you're able to get much more creative when you have these assets that work for you and still appreciate in value. Now the next thing we need to do is start to put into perspective, because you always want to have a number in mind that would allow you to be financially free or even financially secure. So if you're able to convert how much a home is going to make you monthly in whatever market you choose to be in, it then makes it very easy to calculate how many homes you have to obtain before you're able to become financially secure or financially free. So for instance, let's say that a home is making you $600 a month, and you want to be able to make 6 figures a year without doing anything, just owning these properties and having a property manager take care of these homes for you. If you did the math, you would need about 14 homes to be able to make over 6 figures a year. Now, that's incredible to think about, that you only need to obtain 14 homes. And while it may sound daunting right now, think about this. If you were able to obtain 1 home and were able to do a cash out refinance on it, and let's say you got $30,000 to $40,000 out of that cash out refinance. That's a super small number, and more than likely you're going to be getting more out of your cash out refinance than that. But let's just say it is $30,000. $30,000 would be enough, depending on what market you're in, to take that amount and split it in half and use that $30,000 for 2 down payments on 2 more homes. Now you would have 3 homes. So if you think about it in perspective, it's incredible how fast you can build how many homes you have and how fast that passive income starts to evolve. And it just keeps continuing. So then you can take those 3 homes, and let's say they all cash out refinance for a certain amount, but usually you'll be able to double those 3 homes. So let's say you have 6 homes now just after 2 or 3 years, or however long you're waiting to get those cash out refinances or HELOCs. So once you start to obtain more properties, it all starts to just compound on top of each other, and it makes it that much easier to obtain even more properties. Now, this is a lot to think about, and it's a different way to think about investing. So if you have any questions, please leave them down in the comments, and I'll make sure to get to all the comments and make sure to answer all of your questions that you guys have. But for now, for everyone starting out, before I would even start to think about investing into properties and how much each one will bring me and what market to go into, I would get a number in your mind of how much you would need to be making yearly to either quit your job or feel secure enough that you wouldn't have to keep working a different job. Because once you do that, you start to give yourself something back, which is your time. And once you have your time, you're able to go and find different things that you want to do, different ways to invest, and better ways to invest your time So it's making you even more money than it was at a job where you're trading your time for hourly wages. Now in the second video, we're going to be talking about the second way that I found the most value when investing into real estate. And this second way finds a way to incorporate both appreciation and your monthly income. So make sure to come back because it's going to be showing you exactly how you can make a 20+ ROI the same way that you can do with this method. Make sure to like and comment on this video and subscribe to the channel if you haven't. And don't forget to check out the last week's video on real estate that we did because it'll really help clear up a lot of things that we've already talked about in this video for you.